Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I wanted to give you my explanation on what has happened with GameStop stock this week, as well as the stocks of other traditional brick and mortar companies like Bed Bath & Beyond, AMC Entertainment, Macy's, and a few others. And then on top of that, I'll be giving you my recommendation on whether or not you should actually be trading these companies, whether trading their stock outright or the options on their stock. So be sure to stick around for the full video. And so before we get started here, as always, if you are interested in taking a deep dive into options trading, and stock market investing, please check out my courses on Skillshare. I've been teaching on that platform for over a year at this point. Skillshare is a lot like YouTube, except the content on that platform is geared solely towards the purpose of education in the form of online classes. And in my courses, you will see a lot of the detailed research and analysis that I have done using real stock market data, spreadsheets, graphs, and computer programs that I have written to help simulate and prove the concepts that I am teaching. And I've dropped some links to some of the more introductory courses of mine in the description of this video below. Now, you will need a premium membership to the Skillshare platform to watch my courses, but if you do sign up for that kind of membership with the links provided in the description of this video, you'll get an absolutely free 2-week trial. And during that time, you can watch all my courses for free. And then once your trial has ended, it's only going to cost you a few dollars a month to maintain that membership, and you'll gain access to all the future courses I have planned ahead. Skillshare is super affordable. You'll get a ton of value out of it. So again, if you are interested, please check out those links and join the thousands of other students that have already taken my classes. And so now diving in here and talking first about GameStop, because GameStop stock has pretty much been in the spotlight this past week. And in case you weren't aware, their stock has literally exploded by thousands and thousands of %. And though I will not pretend to have all the answers about what exactly has occurred with GameStop and other related companies this week, but from what I've seen in the market and from what I've seen online in terms of the chatter and the news, it's pretty obvious that what has occurred is basically a textbook definition of what's called a short squeeze. And so to give you some more background and context around this, it was a pretty widely held view amongst both the retail investor side as well as the institutional side that GameStop as a company was very likely to go bankrupt in the near future. And this is a reality that a lot of other traditional brick and mortar companies are facing, like Bed Bath & Beyond, like AMC Entertainment, because now, especially with COVID, a lot of their stores, a lot of their movie theaters are completely closed up. And there really is no great way of knowing how well these companies will survive through COVID, if they do at all, and then moreover, how they will continue to perform afterwards. So like I was saying, the general consensus, at least right now in the marketplace, is that these kinds of companies are headed towards bankruptcy. And as a result, there's a lot of short interest on companies like GameStop. And by short interest, I'm referring to the fact that a lot of people and institutions out there have shorted the stock, which, without going into too much detail into what short selling is, it's essentially the way you make money with stock when the prices actually decrease as opposed to buying the stock and hoping the price increases. When it comes to short selling, the way this works on a high level is you literally borrow shares of stock from your broker. You then immediately sell those shares in the marketplace for the current market price, and then hopefully you are correct, the share price decreases with time, so you can buy those shares back for the lower price and make the difference as profit. So for example, if you shorted one share of stock at 10 bucks per share, you'd borrow that share from your broker, sell it in the market for 10 bucks, you take in that $10, and then let's say a week rolls by and that price drops down to 5. Well, then of that $10 you took in initially, you can take 5 of that, buy the stock back, give it back to your broker, and then you keep the difference, that 5 remaining dollars, as your profit. So like I was saying, the short interest or the number of shorted shares on companies like GameStop was through the roof prior to all of this chaos. And so if pretty much everybody is betting that GameStop was going to continue going down in price, what happens if the complete opposite occurs? What happens if GameStop actually starts to increase in price? And the answer to that question in the worst case scenario is exactly what played out this week. Now, there really is no way of knowing exactly what caused GameStop to start increasing in price, but the running theory is that back in September, I believe, Ryan Cohen, who is an investor and the founder of a company called Chewy, initially took a 13% stake in GameStop. And so that caused some excitement, and then he started lobbying for the company to basically move a lot of its business into the online digital world to basically compete with a lot of other online retailers like Amazon. And so this spontaneous hype and excitement caused a lot of other retail traders to also join in on that excitement, and in doing so started to buy the stock. And what usually happens when you do have a large influx of demand and buying for a particular stock is the price of that stock starts to get bid up. It starts to increase. And so as that is occurring, what is happening with all of those short sellers out there, right? They're trying to make money with the stock price actually decreasing. But now all of a sudden, GameStop is starting to increase. And the very risky thing that comes with short selling is that your losses are theoretically infinite, right? Because on the flip side, when you buy a stock, in the worst case scenario, if the company goes bankrupt, the stock price can only fall to zero. So if you buy a stock at a price of 20 bucks per share, and the company goes bankrupt and it falls to zero, well then you're out 20 bucks per share. That's the worst case scenario. But when you short sell a stock, the way you actually lose money in that case is if the stock price actually increases. And there is no ceiling as to how high a stock price can actually go. And so this means at some point, if the stock price does get high enough, the people out there and institutions who have shorted the stock are going to have to buy that stock back and just cover their positions and get out for a loss. And that's very important to keep in mind. To get out of a short position, either for a profit or a loss, you have to buy that stock back. And so this is where the chain reaction of chaos starts to unfold, because as GameStop starts to increase in price, that's going to start blowing out some of those short positions. And so that means some of those short sellers are going to have to start buying back the stock to get out of their positions, which brings in a new wave of buying, which increases the price of the stock even more. And so then once the price of GameStop spikes even more because of that, that once more will blow out even more short positions, again causing a huge second wave of buying so that other short sellers can get out of their positions. And so with that additional wave of buying comes even higher prices for GameStop. And so now I hope you can start to see how this chain reaction is starting to play out. And so ultimately, because there was so much short interest on GameStop, that as this chain reaction started to play out, the resulting immense amount of buying that occurred is what forced the stock to explode by thousands and thousands of %. And this is definitely not the first time this kind of thing has happened. The common comparison that people are making with GameStop is back in 2008, back in October of 2008, I believe, when the same kind of thing, this short squeeze, happened with Volkswagen. And moreover, alongside GameStop, as I mentioned earlier in this video, you have other brick and mortar companies like AMC, Bed Bath & Beyond, Macy's, and a few others that are also exploding in price as well. And so it's pretty obvious based on what's been happening that, like GameStop, there is a lot of general consensus in the market that these other companies as well are very likely to either go bankrupt or certainly not recover anytime soon. And there are some rumors going around actually that because the GameStop short squeeze is so bad that other large institutional players are having to cover their short positions on these other companies in order to actually continue to cover their positions on GameStop. So you have all this frantic buying back of stock for Bed Bath & Beyond, Macy's, AMC, and others that will free up capital in order to allow for continued purchasing of GameStop. And so as a result, the prices of all these stocks are exploding at the same time. Now, I don't know for certain if that really is the rationale or the reason behind why this is all happening together, but it definitely would explain a lot. And so that is my explanation as to what has occurred this week with GameStop and the few other companies that I mentioned. And so now, my last point of this video, I want to discuss, should you actually be involved in trading these companies? And so given that I'm an options trader, I'll talk first about whether or not you should be trading the options on these companies. And if you've seen my Skillshare courses, for example, or you've seen some of my other YouTube videos, you'll know that I'm specifically an option seller. And so talking first about that in particular, should you be selling options, calls or puts or both, on GameStop? And the answer to that question is absolutely 100% no. And the reason for that is twofold. The first reason is the option markets now, because there is so much chaos and because the prices are all over the place, the markets are super wide right now. The difference between the bid and the ask on a lot of these options is extremely, extremely wide. And so as a result, if you are trying to trade options on these companies, whether you are buying them or selling these options, you're very likely not going to get filled at good prices. And at least for me, when I see very wide markets, that is always a huge red flag. The second reason has to do with what's called implied volatility. And I won't get too in-depth into this video, but essentially implied volatility is simply the expected move of a particular stock over a certain period of time. And this expected range is used directly in pricing an option. And so if you are specifically selling options, your edge here is knowing the fact that the majority of the time, the actual move of a stock over the expiration cycle is typically less than the expected range. But companies like Gamestop and Bed Bath & Beyond and AMC, these companies have moved so far out of their expected range that if you were selling options and you did not get out in time, I honestly could not even imagine the losses. And so because these stocks are moving so chaotically, so far out of their expected ranges, I 100% would not be selling options on these companies. Now, when it comes to buying options on these companies, I would also advise against it, but it's certainly much safer than selling options, right? Because when you buy an option, you can only ever lose what you pay for it. So you do have defined risk. That being said, I still would not advise you going out and buying call options or put options on these companies. And the reason for that is because implied volatility, these expected ranges have now exploded. I think the last time I looked up the implied volatility for GameStop, it was around 600%, meaning that as of right now at least, the market is expecting GameStop to either go up 600% more or go down to zero. And so what that means for options is when implied volatility expands, the prices of all options are going to expand with it. And then conversely, when implied volatility contracts, option prices will decrease. And the one thing you must know about implied volatility behavior is that it typically likes to stay right around long-term averages. So when you do get a spike, it will typically contract and go back down to where the long-term average has been. And so now that implied volatility for these companies has exploded so much, it is very likely that in the near future, when these stocks do come crashing down, because they most likely will, that implied volatility will likely collapse along with it. And so what does that mean for option prices? Their prices are going to collapse. So if you were buying options, right, when you buy an option or you buy any asset, you want the price to increase. But if the price collapses because implied volatility contracts, well, then you've lost a lot of your money. So even if you do buy put options on GameStop and the stock comes crashing down to $3 per share, the implied volatility contraction that will happen along with it most likely may leave you still with a net loss on the trade or a very, very tiny profit. I obviously don't know for sure if that will happen, but because of that uncertainty, this is why I still advise not trading options at all on these companies. And so lastly, that brings me to the point of should you be trading the stock of these companies? And my answer to that is maybe. I would say if you stay small, literally trading a few shares of GameStop or Bed Bath & Beyond, then you should be fine. Just keep in mind that GameStop has moved hundreds of dollars in a day. So even trading a few shares of that company could make great profits for you or have you suffer pretty significant losses. But at least with stock, you have that ability to stay super, super small as opposed to options where the contracts are tied to 100 shares per contract. And then also with the issues of their pricing structure with implied volatility, like I mentioned, that's why I would just stay away from options altogether and just trade stock if you really, really wanted to. I personally have no positions on in any of these companies, stock or option. I'm simply a bystander. I'm just watching because it certainly is entertaining, but there's no way at this point that I'm going to actually get involved in trading in these companies. But if you decide to, then I wish you all the best and please stay safe. And so that concludes this video. I hope you enjoyed it. And again, if you are interested in taking some in-depth courses on options trading, and stock market investing, please check out my Skillshare courses. Links in the description of this video. And lastly, if you enjoyed this video, please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. And make sure those notifications are turned on. I'll be dropping new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.